Alibaba's stock was decimated, but the current price of the company offers me as an investor an incredible potential opportunity, as I think the business is really backed up by strong fundamentals. Stay tuned until the end of the video to see why Alibaba is a buy for me and to see whether it fits your portfolio. As always set with educational purposes and is not meant to be taken as financial advice. Let's first analyze the business of Alibaba. As you see, they put it in 7 different categories. 65% of their revenue is coming from the China commerce play, 8% comes from international commerce, 10% comes from their cloud service, 6% is from local consumer services, 7% is from Cainiao, their logistics company, 4% comes from digital media and entertainment, and about 0% comes from their innovative new initiatives. Cainiao is a smart logistics company which ensures delivery within 24 hours to any region of China. The company also shares resources with other logistics companies. Local consumer services is a broad term to describe any digital platform that links users with offline lifestyle businesses and on-demand delivery, from dry cleaners with an online booking service to virtual drugstores that will ship products to your door. Alibaba describes its digital media and entertainment segment as a way to capture consumption beyond core commerce, with gaming, film and drama, and the video platform business. The international commerce of Alibaba is also quite impressive, with large ambitions of becoming the biggest international e-commerce player. In late 2022, this segment serves over 320 million users worldwide. Alibaba owns a little more than 80% of Trendyol, which is the biggest e-commerce player in Turkey, as they also own Daraz, which is South Asia's leading e-commerce platform operating mainly in Pakistan. The China commerce space is the main cash flow cow for Alibaba, with over 1 billion monthly active users. They have one of the biggest platforms of any kind in the world. In terms of market share in China, Alibaba is a clear number 1 with about a 45% market share. JD.com and Pinduoduo are the other 2 top competitors. Comment down below if you want me to analyze them in a separate video. China also has the largest online retail market penetration. As of 2022, China had a 46.3% market penetration, while the US had only a 16.1% penetration. In terms of their cloud segment, for now it is a money loser, but over the coming years, just like Amazon's AWS, most likely it will be a profit-driving machine. For now, Alibaba is in 4th spot in terms of cloud market share, with a 5% global dominance. According to GNW, the industry is set to grow by 30% annually until 2030, which is an astonishing figure. When it comes to Alibaba's latest business results, in Q1 of 2022, they grew revenues by 9%, in Q2 they had 0% growth, and in Q3 revenues dropped by -1%. This is due to higher inflation, lower consumption demand, China lockdowns, and the worsening economic factors overall. These problems are all cyclical and they are not stemming from bad performance from Alibaba or an increase of competition, which would be a concern. As for Alibaba's non-GAAP earnings, they are $11.73 billion for the first 9 months of 2022. With analysts expecting another $4.5 to $6 billion coming in Q4. This means Alibaba's 2022 earnings would be $16 billion. Non-GAAP means we're examining only the real business operating results, as regular GAAP earnings include the change in the price of different company acquisitions, which are not actually a part of the core business results. Also very important to mention is that the company has bought back about 10% of its own shares in 2022, which increases the value of all current existing shares. The current market cap of Alibaba is $200 billion, but they have $45 billion in cash and cash equivalents, and we can subtract that from the market cap, as we're getting that for free when we invest in the company. This means that the real price we're paying for Alibaba is about $160 billion, with earnings of $16 billion. This gives us a price to earnings of 10. This means that even if Alibaba does not grow, we're getting a 10% earnings yield and another 5 to 10% indirect yield from their share repurchase program, which is quite insane. Also, all of these profits are made mainly from the China commerce segment of their business. This is only one of their 7 revenue wings, and in the coming years, most of the other segments could become profitable as well. This will massively increase the earnings of the company, but even if that does not happen, at the current price the company is more than a bargain for me. It also has an impeccable balance sheet with almost no debts and a long-term debt-to-equity ratio of 0.17, which is 3 times lower than 0.5, below which is the optimal place to be. The short-term debt health is also very good, with a current ratio above 1, sitting in at 1.75. The efficiency of the business is also very sufficient. In general, the company has a huge moat, one of the biggest and best in the world. The company has an incredibly low valuation compared to its fundamentals. It also has very low debt levels and very high efficiency ratios, making Alibaba tick all 4 tickers, making it a definite buy for me. So if you learned something new, like the video, subscribe to the channel, and make sure to watch all of my other deep dive analysis on the channel on other stocks. Goodbye for now, and until next time.